Welcome back to Investing Talk Podcast.
Today we're looking at Redwire Corporation.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it. Redwire is a fascinating one. On one hand, you have this incredible proprietary technology for space.
Absolutely critical hardware.
Right. But on the other hand, the financials, they're facing some pretty intense challenges. The stock has been all over the place.
It really has. So I think the core question for us today is, how does a company with such a seemingly bulletproof tech advantage justify the cash burn and the risk that investors are taking on?
Exactly.
Yeah.
Is that technological moat? Is it deep enough to get them across the financial chasm?
That's the question. And to start, for anyone who doesn't know, Redwire isn't launching the rockets themselves.
No.
They're what we call an upstream provider. They're making the mission-critical guts of the spacecraft. Think avionics, power systems, navigation, all that complex stuff.
And their story just got a huge shot in the arm recently. You couldn't really miss that stock surge. It was almost 12%, I think.
It was huge. And it came right after two massive contract announcements.
The big DARPA one, right?
Yeah.
The Otter VAO contract.
That's the one, a $44 million Phase 2 deal. And on top of that, an 8-figure contract for their Nix docking system. For the market, that was just instant validation.
Okay, so let's break that down. When you talk about their competitive advantage, that Nix deal seems to point right at it,
Yeah.
their docking mechanism.
Yes. The International Berthing and Docking Mechanism, or IBDM, it sounds a little underwhelming, a docking mechanism, but this is the core of their moat.
Why, though? I mean, it's a piece of hardware. How is that so defensible that it changes the whole investment case?
Because it's not just hardware. It's expertise, it's certification. This technology is compliant with the International Docking System Standard, IDSS.
And that's a big deal.
It's everything. Think of it like the global gold-plated safety and interoperability standard for space. To get that, it takes years of just rigorous testing, government approvals.
So it's not something a competitor could just reverse engineer next quarter.
Not a chance. And that certification is what lets them build the hardware for flagship missions. We're talking resupplying the International Space Station or being a key piece of the upcoming Lunar Gateway.
Ah, okay. So the moat isn't the physical part. It's the fact that it's the only game in town with the right credentials to be bolted onto these huge multi-billion-dollar government platforms.
Precisely. The switching costs become astronomical. You're not going to rip out a mission-proven, certified system to save a few bucks. It defends their market share against the huge players who would otherwise dominate.
That makes so much more sense. Okay, so if that's the tech foundation, let's talk about the growth that analysts are now forecasting. It's pretty aggressive.
It is. The consensus is looking for sales around $132 million next quarter, but the number that really jumps out is the full-year forecast.
49% revenue growth.
49%.
I mean, that's incredible acceleration. The rest of the space industry is what, maybe growing at 10%?
If that, yeah. So that 39-point gap, that tells you the market believes Redwire has something truly different. They're not just riding a trend, they're creating one.
So if the docking system is the defensive moat, what's the offense?
The DARPA win. That showcases their SaberSat platform. Yeah. And this gets into some really groundbreaking tech called air-breathing electric propulsion, ABE.
Right. ABE. What does that actually let them do?
It unlocks a whole new area of space, very low Earth orbit, or VLAO. We're talking 90 to 250 kilometers up.
And why go that low?
Huge benefits for observation and security. You get much lower latency, much higher resolution imaging. Things move so fast down there, it's incredibly resilient.
But isn't VLAO basically a death zone for satellites? The atmospheric drag just pulls them down, right?
It is. For traditional satellites anyway. They have to burn precious fuel just to stay in orbit, and when that fuel runs out, the mission's over.
So how does AB change that?
Well, it's genius, really. It operates like a jet engine for space. But instead of carrying fuel, it uses the tiny traces of atmosphere that are still present in VLAO.
No way.
Yeah. It scoops up those atmospheric particles, ionizes them with electricity, and shoots them out the back for thrust.
So the drag that used to be the enemy is now the fuel.
Exactly. It lets a satellite stay in VLAO for years, not months. And that's the proprietary capability that DARPA is banking on for persistent surveillance. It's a massive differentiator.
And on top of that, they made that edge autonomy acquisition.
Right, which brought in autonomous ISR and UAS capabilities that gives them this really valuable dual-use portfolio.
So they can sell to both commercial space and, more importantly, the national security defense customers.
Yes, and it was a clever move. It broadens their market and creates these immediate cross-selling opportunities into government security agencies.
Okay, so the technology story is fantastic.
Yeah.
Strong IP, mission-critical status, groundbreaking propulsion, but now we have to hit the reality check.
The financial reality check. This is the big conflict in the thesis. We have to talk about the profitability hurdle.
Yeah, that volatility is there for a reason. The trailing 12-month net income is, what, a negative $268 million?
It's a huge number. And free cash flow has been consistently negative. It's a high-cost operation, no doubt about it.
The market sees it. That's why the price to sales is higher than the industry average and why the stock's beta is like 2.49. It moves fast.
Very fast. We saw it right. A single earnings miss caused a 30% price drop almost overnight. The market has zero patience when you're burning cash that quickly.
So the critical question becomes, what is management doing about it?
Well, their strategy is it demands patience from investors. They are intentionally taking all the capital and plowing it right back into growth programs like SaberSat. No buybacks, no dividends.
It's the classic growth stock trade-off. You sacrifice profits now for market share later.
Right. But the key thing here is that these huge new government contracts, especially the DARPA one, they come with progress payments.
Meaning the government is basically providing non-dilutive funding as they hit milestones.
Exactly. It helps the balance sheet during this big ramp up. Their whole goal is to hit what they call the free cash flow inflection point the moment they turn positive, sometime in 2026 or later.
2026 is a long way off. Why should investors trust that timeline when the market is so punishing?
That's the right question. And the trust, I think, comes from the nature of the contracts. Government and national security programs have a much higher degree of certainty than commercial ones. If they nail phase 2 of this DARPA program, it de-risks the whole business model.
And it probably opens the door to even bigger classified work down the road.
That's the bet. The risk is about execution, not whether the technology works. That part's already invalidated.
Speaking of belief, the stock's recent action is pretty telling. A 52-week range from under $5 to almost 27 is wild. But now it seems to be finding a floor.
It does. That 27% bounce last month suggests the new contracts have brought in serious institutional buyers, and the technicals show momentum is building.
And the analyst conviction is just off the charts. The average price target is over $17. That's implying, what, more than 100% upside from here?
It's a huge target. They're not just projecting, they're believing that this company makes the leap from an R&D story to a scaled infrastructure provider.
And that belief seems to be backed up by who's buying.
For sure. You had a big financial sponsor, Bain, selling some shares, which is normal post-IPO, but that supply was soaked up pretty quickly. And more importantly, it was absorbed by management.
That's always the signal you want to see. The CEO, the EVP, the CAO, all buying shares on the open market after all that volatility.
It's them telling the market, we see the challenges, but we believe in the backlog. And it's not just them. A big institution, Hood River Capital, just took a new position, about 2.2 million shares.
All right.
Yeah. And you combine that with call option volume being up over 60%. It really looks like smart money is positioning for a significant move up.
They're looking past the short-term cash burn to that 2026 inflection point. So what are the key milestones for us to watch over the next year?
The first big test is the early November 2025 earnings report. The market needs to see that they're ramping up these new contracts successfully. They have to hit or beat that consensus sales target of $132 million.
That proves the engine is running.
Right. And longer term, it's all about progress updates on that DARPA program. They have to show ABEEP is working flawlessly in the real world. That unlocks everything else.
And then there's the more speculative stuff. Any more work on the Lunar Gateway or more expansion in Europe after the Knicks deal?
Exactly. Those are the future catalysts that justify those high analyst targets. And of course, you can't ignore the macro backdrop.
A big tailwind. The whole sector rotation into space and defense, driven by bigger defense budgets, helps them directly.
And if we see any future rate cuts, that immediately eases the cash burn concerns for a high-growth stock like this one. It could really accelerate a move up.
So we started by asking if the tech moat was deep enough for the financial risk. What's the final takeaway?
I think what you're really looking at here is a long-term asymmetric opportunity. You have this company with unique IP-protected tech that solves critical problems for customers with decades-long budgets. The high certainty contract backlog seems to outweigh the short-term burn, but only if management executes flawlessly on that path to turning cash flow positive in 2026.
A big if, but with a massive potential reward.
It could be transformative if they get it right.
That raises a final thought for you to chew on. Just like a few companies came to dominate railroads or fiber optics, could Redwire be positioning itself to be the unavoidable infrastructure monopoly for the next generation of space docking and maneuvering? Keep that in mind as you track their next earnings release. If you want more insights into high-growth companies in disruptive fields like space and defense, make sure you hit that subscribe button.